At this point, you should have an understanding of the basic accounting equation. Assets equals liabilities plus stockholders' equity. Now, this is in case of a corporation. It could be owner's equity if we were talking about a proprietorship, or partnership equity if we're talking about a partnership. We're focusing on a corporation, though, so we're going to have stockholders' equity. Under that, remember, assets are resources that bring us future economic benefit. They include items like cash, receivable, supplies, prepaid items like rent, insurance, and then equipment and long-term assets, machinery, buildings, things of that nature. Liabilities are things we owe. That would include payables. That's also creditors' claims to our assets, deferred revenue, and notes payable. There are others as well, bonds and leases, things of that nature, but this is general liabilities. And then stockholders' equity. At first, we're going to keep it very basic. It has two areas within stockholders' equity. One is paid-in capital. This is the owner's investment, so that's your common stock at this moment. It could be other forms of stock as well, but right now we're going to stick with common stock. That's the money the owners, in theory, have invested into our company. And then retained earnings is the amount of capital the company has generated itself. And you get that through revenues, and then revenues cost us money, so that's expenses. And then if we pay anything to our owners in the form of dividends. So retained earnings really is the capital the company generates itself and keeps within the company. All right, so let's look at some business transactions, and let's look and see how does this impact the equation. Everything that impacts the financial equation, the accounting equation, the financial position of the company must be recorded and then reported to external users, such as investors and creditors. And we do this following GAAP. So what we're going to do today is we're just going to look at a series of transactions, and we're going to decide how does it impact this equation, with the understanding that this equation must always be in balance. So for every action, there's a reaction. Sounds sort of like science, right? In the theory, that is true. For every action, for everything that happens in the equation, something else has to offset it, because everything we have as assets has to have a claim against it. Whether it's creditors' claims or owners' claims, everything has a claim in a business. So let's start with this first December 1st transaction. We sold shares of common stock for $30,000 to DJ, the owner. So notice the owner here is purchasing shares of stock. In other words, the owner is investing into our company. Now in accounting, we must follow the economic entity assumption. We're accounting for the entity, not for the owners. Okay, so everything that happens, we're going to look at it from the lens of the company itself. So if the company sold shares of stock to the owner, then the company received $30,000. So the way I want you to approach this, always think of the accounts that are involved. What's actually happening here? Well, one, when we sell something, we receive $30,000, that's cash. Well, if you receive cash, your cash would be going up. So in theory, our cash is going up here in this transaction, or not in theory, in actuality, our cash is going up here by $30,000. So we're going to go to our equation and say, okay, my cash is going up $30,000. Cash is an asset. Why is that? Well, it's a resource that we have that brings us future benefit. Now, why did our cash go up? Well, here the owner gave us the cash. Now, a lot of people want to say our cash went down. That's the owner's perspective. Remember, we're not looking at it from the owner's perspective. We're looking at it from the company perspective. So the company's cash goes up. Well, why? Because the owner contributed money. Well, again, going back to the equation, what represents the owner contributing money? Well, that would be stockholders' equity. That would be our paid-in capital. In this case, our common stock. So when we issue common stock, our common stock is also going to go up. So our equation remains in balance. Our company now has assets. We've got $30,000 in assets. Well, who has claim to it? Well, at this point, it's not a creditor that has claim. Our actual owner has full claim at this point at $30,000. So we've balanced our equation. All right, let's look at the second transaction that a company may take part in. Borrowing $15,000 from Wachovia Bank and signed a note. The full amount of the note is due in 2 years. So this is a 2-year note. We're going to pay it off 2 years from now. When we borrow money, this is very much like when you borrow money, what happens? Well, think about it. If you borrow funds, you receive what? Cash, right? Your cash is going to go up. So we're going to go and say, okay, our cash goes up. Where does cash fall into the accounting equation? Well, cash is an asset to us. So in this transaction, our cash is going to also go up by $15,000. We've borrowed funds. We now have an asset that we didn't have before this transaction took place. Now, in that, why did we get this $15,000? Did we sell something? Did our owner give it to us? Well, no. We borrowed money. Well, what's borrowing money? Well, that means someone else has a claim to it, right? Wachovia Bank, our creditor, has claim to that. Oh, so that means our liabilities are going up. Well, which liability? Well, it says here we signed a note. So we're going to look at it from a notes payable. So we're going to go down here and say, oh, our notes payable is going up by, oops, I'm in the wrong line, going up by $15,000. Now notice for some crazy reason, this does not have a box around it. So let's fix our border really quick. There we go. Our notes payable. Now keep in mind, payables are going to be amounts we owe to others. A notes payable is a signed document. A receivable is amounts owed to us. That means we're going to receive money in the future. Therefore, a receivable is always an asset. A payable is going to be a liability. All right, our equation's in balance. Now we do have $45,000 in assets, but our owner doesn't have full claim to that. Our owner has claim to $30,000, while our creditors now have claims. People we owe money to have claims of $15,000. However, the equation does balance. All right, let's look at the next transaction. On December 1st, we purchased equipment. Now, just stop there. Purchased equipment. What are we getting as a company? Well, we're getting equipment. Now, when we buy something, there's a couple of ways you can buy things. You can either pay for them immediately, and that would be using your cash, or you could buy them on account, which means you owe for them in the future. Think of your credit card, right? You buy it on a credit card. You didn't pay for it. You owe money because eventually you will have to pay that credit card bill. So when you purchase equipment, one, you know you're getting equipment. So our equipment must be going up. We're getting an asset that we didn't have before. So let's go to our equipment and say, hey, our equipment's going up by $12,000. And this is basic what we do in accounting as far as every transaction that happens. We as accountants have to analyze it, decide how does this impact our financial position. Now, some of them are simple and we never think about anymore. So the systems really handle these types of transactions for us. But as people taking Introduction to Accounting, you have to understand that every business transaction that impacts that equation has to be reported. So we have to really understand when you make business decisions how you're impacting the financial position of the company. Okay, so we purchased equipment. Equipment's going up there. We've got an asset to use. Now, how did we purchase it? Well, we purchased it to use the operation of the company for $12,000. Well, obviously, we paid cash for this transaction. So in this case, our equipment's going up. However, our cash is going to go down. This is known as an asset exchange. The claims haven't changed. We still have creditor claims and we still have owner claims here. It just means now that they have claim to this equipment, not the cash, because we've moved that cash asset into an equipment asset. Now, why is it important that it says to use in the operation of the company? Well, some companies buy equipment to resell it. Think of Walmart. They buy TVs to resell. In that case, that would be an inventory item. And we'll cover that later when we talk about merchandising transactions. But why is it important that they use it in the operations? Well, then it's not an inventory item. It's not something they're going to resell. They're going to use it within their own operations to generate revenues. Okay? So that's a very important distinguishment there. All right, so that asset exchange, one asset for another. It is possible to impact only one side of the equation. The only rule is the equation must always be in balance. All right, December 1st, our next one, we paid for 1 year of rent in advance for $6,000. Well, keywords, always think about the transaction. If you pay for something, what's the only way you can pay for something, even in your life? Well, it's cash, right? You have to pay for it in cash. Now, cash can take many different forms. You can write a check. You can use a debit card. You can actually have cash. Maybe you're paying in Bitcoin these days. I don't know. All of those, though, in theory, are some type of cash that your company has or a cash type equivalent. So those would be cash. So in this case, our cash is going down because we paid. So we're going to go down here and say, okay, our cash is going down by $6,000. What else is happening? Well, in this case, we're paying for rent. Now, in theory, rent is an expense to us. We pay it, it generates revenue for that month, and we go on. But now in this case, we're not going to see the full benefit of the rent in this accounting period. We're prepaying it. We're paying for a full year. That brings us to the expense recognition principle that we must understand in accounting. Expense recognition, we must recognize expenses in the period they are incurred to generate revenues. Now, when we pay this rent in December, is it just generating revenues for this period, the month of December? Well, absolutely not. It's going to generate revenues for this period, but we're going to have this space and we're allowed to generate revenues for a full 12-month period. So we do not want to recognize the full expense at this moment in time. What do we do then? Well, we call that a prepaid item. We actually capitalize it because it will generate revenues in the future. So we want to recognize it as an expense in the future. So we're going to go in and we're going to do $6,000 in prepaid rent. Now, what if it said we paid $6,000 for the current month? Well, in that case, that would just be an expense because it's not going to generate revenue outside of the current accounting period. So we would want to actually expense that. Expenses are part of retained earnings. So we would go down and expense it. So timing does matter. GAAP-based accounting. GAAP stands for Generally Accepted Accounting Principles. GAAP-based accounting is an accrual-based method. We recognize items in the period they actually generate revenues when we're talking about expenses. So here, we're going to push off the recognition of the expense until it actually allows us to generate revenue. Okay, so that's an accrual-based system. Okay. Now, cash-based systems, which are non-GAAP followers, so private companies can do that, small mom-and-pop shops, proprietorships and partnerships, they can recognize expenses when the cash is paid. GAAP-based companies must recognize them in the period in which they generate revenue. So therefore, this is going to be recognized over that 12-month period, not all at once. So we're going to call that a prepaid for now, and then later on we'll expense it as it allows us to generate revenue. Again, that's another example of an asset exchange. All right, December 4th, we provide printing services to customers for $6,200 on account. Ooh, let's talk about this just a little bit. Now remember, DJ Printing, we are a printing company, so therefore we're going to print stuff for people, whether it be, just regular copies of stuff, or maybe we print signs and posters. We really don't know what DJ does, but in this case, they're providing printing services, so they're doing some type of printing. They're creating banners or posters or just general booklets or copies of things to our customers for $6,200 on account. Now, first and foremost, anytime we're a company and we provide our service, we are recognizing revenue. So a lawn care company, for example, they go out and they mow a yard. They've generated revenues for that company. Does it mean their client has paid them already? Maybe not. You may bill your client. For example, your power company provides you power. They provide that service to you. You don't pay for it every single time you use a kilowatt hour. You don't have a thing where you send them money every single kilowatt hour you use in power. You wait until the end of the month, they bill you for that. So they bill you on account, right? So when they provide services, either you pay for them immediately or they bill you later. But once that service is provided, we get to recognize revenue. Revenue recognition states we get to recognize revenue, the very basic form of revenue recognition. Now, there's a true process to recognition, but at this stage, all we need to know is the basic definition of revenue recognition, okay? Revenue recognition, we recognize revenue once the obligation to the customer is complete. In other words, once we provided the service or once we've sold them the good, once that obligation is complete, we get to recognize revenue. So here, if we provided the services, our obligation to the customer is complete. So therefore, we get to recognize revenue. Revenue is assets generated by the company themselves. So it's going to be part of our retained earnings. So on December 4th, our retained earnings is actually going to go up $6,200 because revenues increase the owner's claim. As the owner provides services, they generate assets for the company. So therefore, they have claim to those assets. Just like when you go out and work for an hour, you have claim to the hour's salary. That is your asset. That's you generating revenue for yourself. Companies are the same way. They generate revenue for the entity Therefore, it goes into retained earnings. This is the capital generated by the company itself. Now, the second step to this is on account, $6,200 on account. Well, obviously, our customer does not pay us for this, so we're going to go in and say, okay, what is on account? That means our customer owes us money. Well, what represents a customer owing us money? That would be a receivable. So our receivables are going up because now we have claim to that payment. Hopefully our customer will pay us, and we'll talk about that in a future chapter if they don't, or a future video. But in this case, hopefully our customer will pay us. We expect them to pay us. We will put this in as a receivable. We will bill them and eventually collect that in cash. Why is it an asset? It brings us future benefit. Eventually we're going to receive cash, which we can use to operate our business. So be careful there. When we provide services, we will either collect them immediately. That would be a cash transaction. Or in this case, we're billing our client. We're going to invoice them in the future. So we put it on account. That means they owe us money. That would be accounts receivable. All right. December 5th, we purchased $2,500 of supplies on account. So how does that impact the position of our company, the financial position? So anytime you want to, as I go through these, pause the video and then try it on your own first and then come back and watch that segment just to see how it goes. So one, we purchased $2,500 of supplies. Well, what did we receive as a company? Well, we received supplies. Now, in theory, that pencil is an expense to your company, but we're not going to use all those supplies immediately. So it may generate revenues for multiple periods. So it goes back to that expense recognition. So what we're going to do is when we purchase supplies, typically, especially if we purchase large sums of supplies, we're going to go in and we're going to place those on our balance sheet as assets. So those bring us future benefit. We can use those supplies for future revenue generation. For example, paper. Well, if you buy 50,000 reams of paper, you're not going to use all of that in the month of December. You get a volume discount, that's going to be your year of supplies there, your year of paper, so to speak. So you're going to call that a supply, and then as you consume those supplies in the proper accounting period, we will expense them out. So our supplies are going up. Now, anytime we purchase things, just like when we purchase the equipment, we can either pay for them or we can put them on account. Here we're placing it on account, which means we're not paying immediately for those goods. We owe for those goods. Things we owe are liabilities. Those are creditors' claims against our asset. Since it's on an account, and we did not, notice up here we signed a note. Here we just placed it on account. Since it's on account, that's going to be an accounts payable. So our liabilities are going up. We owe for it. That's going to be an accounts payable. If it said we signed a note, it would be a notes payable. But think of your power bill. When you receive that power bill, you've already used the power. That's an accounts payable. You owe the power company money. You typically have 25 to 30 days to pay that without penalty. So that's an accounts payable. All right, very good. All right, so on account here. Sorry, I was highlighting the wrong line, but on account. December 10th, we provide printing services to customers for $4,500, and notice cash. So here, pesky words, providing services. When we provide services to our customers, that's revenue. We generate revenue. Revenue is part of equity. The owner has claim to that. It's under retained earnings because it's company generated, not owner invested. All right, so our company has generated this itself. We're going to go in and increase our retained earnings. Again, that would be service revenue would be the specific account under retained earnings. So if you want to make a note over here to the side, you can just write out service revenue, same way with this, just so you know that that's revenue that's being generated. Retained earnings is comprised of revenues, expenses, and dividends. Now, we will keep adding to that as you learn more and more about accounting, but right now, in the basics, retained earnings is made up of what I call the red accounts: revenues, expenses, and dividends. R-E-D, revenues, expenses, dividends. If you can remember the word red, you can remember the basic components of retained earnings. So that's revenue there. All right. Let's move on to December 14th. We received $2,400 from a customer in advance for 1 year of printing services. So maybe this customer has so many copies they need every single month of a flyer or a poster. So we said, okay, why don't you go ahead and pay us? We'll give you a discount. You pay us up front. All year we'll print these posters or flyers for you. And they agreed. So one, received $2,400. Well, if you received $2,400, what'd you get? Obviously, you had to get some cash in there, right? Either they wrote you a check or a debit card, something like that, but you get cash. So our cash is going to go up, so make sure I'm on the right line here for December 14th. Oh, you know what? I forgot to finish out this December 10th one, didn't I? Oops, my apologies. I forgot to type in there that cash went up. I was looking, I was like, ooh, our equation doesn't balance. So go in and put your cash in there, 45, before you move on to the next one. That's always important. Sorry about that. I'm not going to re-record this video for that one little snafu. We're already 20 minutes in, so keep that in mind. All right, 14th, received $2,400. So our cash is going up by $2,400. Now, why is that? Well, the customer has paid us in advance. Have we done anything to earn their money? Absolutely not. So we cannot record this as revenue because we owe the customer future services. So that's not revenue to us yet. We haven't, fully met our obligation to our customer. So that says we owe something. We owe them a service. So that would be deferred revenue. So we're going to go in and say, hey, we owe our customer a future service. So that's a liability. It's not an accounts payable. We don't have to pay them cash. We didn't sign a note. Deferred revenue, it may also be termed unearned revenue. If you're watching other videos out there, you may see unearned revenue. It's the same concept. We've received money up front. We haven't earned it. So we're deferring the recognition. We're pushing off the recognition of that revenue into the future period when we actually do meet that obligation. Deferred revenues are extremely common in the corporate world or in the marketplace. Think of gift cards. Every time you buy a gift card, the company has not earned that money. You go to Walmart, you go to Target, you go to Amazon, you buy these gift cards for future purchases. The company has received payment. You've given them $100 for that gift card, but they have done absolutely nothing to earn it yet. So deferred revenues are actually very common in the marketplace. Most people are like, oh, nobody has deferred revenues. There's a lot out there. Every gift card that's sold, and there's a lot of gift cards sold, is a deferred revenue. Airline tickets is another example. You buy your ticket before you ever take the flight. So the airline hasn't earned it yet. They have to give you a flight or give you your money back or give you some form of payment if they don't complete that flight. Those are all deferred revenues. You're pushing off into the future. That means you owe your client. We don't always have to owe money. We can also owe a good or a service to our customers, and that's what deferred revenue is. We owe a good or a service to our customers. All right? So that's going up $2,400. We are in balance. As we provide those printing services, then we get to recognize it as revenue. So eventually this deferred will become revenue. We will earn it ourselves. But at this moment, we have to show it as debt that we owe our customers. All right, December 20th, we collected 1/2 of the balance due from customers on December 4th. Remember, we provided services to our customers on account. Well, here on the 20th, half of our customers, or half of the payments come in. I don't know how many customers that is that's paying us, but they're paying for half of that. All right, so what's happening? Well, if we collect, our cash is going up. You've collected part. So our cash is going to go up. And in this case, our cash is going to go up by $3,100, or 1/2 of the amount owed. They owe us $62. They're paying us $31. Now, a lot of people, when we collect money, want to recognize more revenue. Absolutely not. We didn't do any additional services for our customers. We didn't provide them any additional work. They're simply paying us the amount they owe. Well, what represents amount that customers owe us? Well, receivables. So here our accounts receivable, when they actually pay us, they no longer owe us money. So our accounts receivable is going to go down. Again, that's an asset exchange. We're removing the receivable. They are now paying it, and it's becoming cash. That means our customer still owes us $3,100. So that's, again, future benefit. They will eventually pay that, hopefully. All right. December 26th, paid $250. Again, anytime you pay, you know cash is involved. Your cash is going to go down for your company. Again, whether it's a check, a debit card, or anything else in the world, Bitcoin, whatever you're using, your cash, whatever you're using as cash, is going down. Now, why did our cash go down? We ran an advertisement this week in the local paper. Well, advertisement would be an expense, so that would be an advertising expense to us. That's part of the cost of generating revenue. By advertising, we get our name out there, we lure customers into our company, hopefully. So advertising would be an expense. It's the cost of generating revenue. So that's part of equity. We've generated this revenue, but we also have to pay to generate revenue. You're like, wait, that doesn't make sense. Why do we have to pay to generate revenue? Well, think about you. You go to work. Does it cost you money? Well, absolutely. One, every hour you work, you have to pay tax on it. That's the cost of generating revenue as individuals. Also, you had to get to work, so it probably cost you some form of transportation, either gas in your car, a ticket on the express train, or whatever you're doing to get there. It costs you money. Revenue is never free. It always costs us money to generate revenue. For a company, part of the cost is advertising so that you can draw more customers into your company. As it costs us money, it offsets our retained earnings. It reduces the overall amount that we contribute to the assets as a company. Hopefully, our expenses are always less than the money we generate. Okay? In your personal life, you have rent, you have food, you have gas. All of those are expenses because without them, you couldn't generate revenue. So it's the cost of generating revenues, income. All right? Now, as expenses go up, equity goes down. So the more we pay out in expenses, the less we have claim to as a company. All right. December 30th. Paid employee. There we go. Paid again. So that means we're paying out cash. We paid employee monthly salary of $3,000. It does cost us money to generate revenue in that we have to have employees. Either, sometimes you can work for yourself and be just sole proprietor. That would be a draw or a dividend in a corporation. But sometimes we have employees and we have to pay them to help us generate revenue. So if you have a lawn care company, you have to have employees to go out and mow all the lawns as you grow. That's part of generating revenue. So we're going to go in. Again, it said paid, so we know our cash is going down. Employee salaries would be an expense to us. Expenses are part of retained earnings. Our retained earnings go down. As expenses go up, retained earnings go down. Now, this is driving me a little bit crazy, the formatting, so let me move those over so that they line up. There we go. Once we got these single digits, they no longer lined up, so fix that. All right, so expenses, again, reduce our owner's claims to the assets. It's the cost of generating revenue. And December 31st, paid $500 in cash dividends to the shareholder. Sometimes the company will pay part of the earnings out to the owner. That's called a dividend. Dividends are not expenses to our company, but they do reduce our equity. So paid, again, would indicate cash, so our cash is going to go down. And then also our equity is going to go down. Dividends are part of retained earnings, and as you pay out your earnings, your actual equity is reduced. All right, so now, I'm not going to, but at some point y'all can add all this up. Once you do add your assets up, you should see your total assets equals your liabilities plus your stockholders' equity. Everything we've done has a equal part, so I know we're in balance here. But that's just understanding the basic concept. In business, everything that impacts our financial position, assets, liabilities, and equity must be recorded and reported. And that's what financial accounting is. There's multiple forms or different fields of accounting. Financial accounting is one part. The goal of a financial accountant is to make sure everything that the business takes part in is accurately recorded and accurately reported to our investors and creditors, our owners and our creditors here, okay? That's the point. So every transaction that does happen, when you make a decision in a business, you have to understand how does it impact the financial position. And if it's not positive, sometimes you may want to consider an alternate transaction. So make sure you understand everything that happens to that equation as you take part in business transactions. All right, so this is part 1. We will come back in part 2 and do exercise 2 here in a separate video. But this video is getting a little long. I want to keep it under 30 minutes, so we're going to cancel there. We'll come back and do video 2 here in a little bit. Have a great day.